Zed Franics is joining us. He's the guy who's been helping me understand this relationship for some time now. He's a CIO and co-founder at Convexitas. Zed, good to have you here this afternoon. So we've got a little time here to break this down. Let's take it step by step. Did we learn anything new from Jay Powell today?
No, I think it just reaffirms a handful of thoughts that we've already had and discussed. But I think to take a step back, what is the Fed actually trying to do when they use their two levers of lowering rates or asset purchases? Ultimately, what they're good at historically at controlling is increasing asset prices, and that's by forcing people out the risk curve. If they're either making treasuries unattractive by lowering rates or straight up purchasing your treasuries or MBS or now even credit, they're trying to push people into the equity market, inflating asset prices. Now, the reason they want to do that is their belief is higher asset prices will create jobs. If you have a project that's going to cost you $100 million and your expectation is going to distribute $10 million of earnings every year and current market valuations are 10 times earnings, you're not going to do that project. Why would you take a risk on investing $100 million to only get $100 million of asset value back? But if valuations are saying 20 times earnings, then you're going to do that project. You're going to invest $100 million to hopefully get $200 million of asset value back at the end of that project. And that's job creation. Okay. And their view is those higher asset prices leading to this job creation eventually leads to price inflation. Once the labor market tightens, that's when you're going to actually see sustained price inflation. But that's their thought process. They don't actually think that higher asset prices directly lead to higher inflation.
Sure, just kind of want to gauge where we are in the process.
So what we're seeing right now is obviously higher asset prices. We're obviously off the all-time highs, but still reasonably high, and we're starting to see inflation. But because we're skipping the middle step, job creation does not look overly enticing at a couple 100,000 or even less per month. And their view is we're currently sitting at 10% real unemployment. So the Fed actually doesn't think that we have sustainable inflation. This isn't just kind of lip service by Powell. Most economists and the Fed themselves do not believe sustained inflation can happen without wage inflation, i.e. a tight labor market. Thus, right. If they believe that real unemployment is 10%, that all this inflation is going to be temporary, transitory. These are the words that we're hearing.
So he used that word again today quite a bit, Zed, but how come we see this response? So you're going through kind of the economic path that they might be viewing as a way to get the economy in a positive inflationary environment, one that brings jobs back, et cetera. In the meantime, right now, though, what he's saying is, well, the inflation risks are transitory, and the market should like that, right? Nobody wants inflation. So how come we're having this vast repricing of assets that is pretty undiscriminating in the stock market, and for bonds now pushing at the highest yield we've seen of this recovery? Why are we getting that if there is no risks to imminent inflation that will be dangerous?
Yeah, so it's a combination of current valuations and having an incredibly low interest rate environment. Essentially, all asset classes have a larger interest rate component to their current valuations than ever before. Quite simply, if you own fixed income, your ag investment, it has an 8.5 duration, where only 5 years ago that was a 5.5 duration, meaning every movement in interest rates is going to have a more significant effect on the price of those investments.
Okay.
Real estate, quite similar. Real estate trades on cap rates, which essentially is tied to interest rates. So as interest rates move, those real estate investments have a longer duration, and you think the fair value of those real estate investments are going to move along with interest rates. Similarly, in equities, when equities have really high valuations, that means the earnings today are less important to the overall price of that equity. It's the earnings in years 5, 10, 30 years out, or terminal value of those equities are what's driving price. Meaning, once again, it's a very long duration asset. And then you have things like VC, which are the ultimate long duration asset. It's investing in companies that you expect to actually lose money for 1, 3, 10 years, and thus all of the expected returns, those cash flows, are way in the out years. So essentially, all asset prices, due to a mix of high valuations and low interest rates, have more duration associated with them than ever before, meaning when rates move significantly in either direction, a significant rally in rates, you'd expect all assets to rally. A significant sell-off in rates, you expect all assets to sell off. So we're sitting in an environment where as long as rates are moving in a dramatic fashion, expect asset prices to be much more correlated.
So, Zed, here's where it might get alarming for bulls then, okay? Because if you're saying that the correlation's going to hold in both directions and the 10-year yield looks like it's on a mission higher, which means lower in price, of course, then should we understand this to also mean a lower price for stocks that will trend and not just be a corrective mechanism? What do you think is going to determine whether or not the move here in yields is enough to actually create trend reversal in the NASDAQ as opposed to, say, a valuation reset? Because what I hear a lot of right now is history tells us yields go up when there's economic growth. That's good for stocks, and it shouldn't be an issue. I know your duration point here is arguably the difference, right? That our duration is at a record. But how do we know if this actually means trend change instead of a pocket in a moment?
Yeah, so I think there's two portions. Exactly what you said, that all assets just have more duration than they had prior, so the interest rates are just having a greater effect than they did previously. So
Okay.
that's one bit for sure that I think is a little different than previous. The possible real issue, though, for an investor is the correlation side of things. Right now, if you hold fixed income, real rates of return are approximately -1% on the 10-year. So you're essentially losing 1% every single year to inflation to hold that asset.
Real yields.
Now, if you're an investor and you believe that treasuries are going to be negatively correlated to all the risk assets in your portfolio, you're probably willing to go ahead and essentially pay 1% to add diversification to your portfolio. But if everything flips and everything becomes positively correlated, do you have any interest holding that fixed income asset that has an expected, real return of -1% if it's actually be positively correlated with all your risk assets? And the answer is no. You actually probably don't want to be holding those treasuries. And I think this kind of creates a little bit more of an air pocket, if you will, for where rates can actually go. Because if you as an investor believe that treasuries are positively correlated to equities, how much would you have to earn for holding treasuries for make them an interesting asset?
So we're going to explore basically, Zed, where treasuries as an income and a pure yield play becomes appealing, right? So like a pension fund, for example, that says, okay, I get 3%. That sounds good to me. I'm not worried about mark-to-market stuff. I'm just going to hold this baby all the way through to duration. That's what you're saying, right? Because there's a lot of different types of bond holders, but those are the big ones, those kind of forced buyers that have to buy them. But have they really been the players in this market at negative real yields? How do we know where that threshold is where someone will say, you know what? If the price will go up and down, I'm going to hold this thing all the way through to the maturity?
Yeah, the answer is there's a decent amount of space between now and where they become acceleratingly interested in owning treasuries. So corporate pensions are almost 90% funded, meaning that they've already de-risked quite significantly. So a lot of the month-end rebalancing that people talk about, those numbers are just shrinking and shrinking and shrinking as these pensions become close to fully funded or basically running out the clock. They're just going to have their buy and hold portfolio, pay down their pension through time. They're going to have much less of an impact in the market going forward. Public pensions still use discount rates of 7 or 8%. So, they're very unlikely to be interested in 1.5% 10-year, 2% 10-year, 3% 10-year. That if your discount rate is 7, 8%, you need rates a lot higher before you become interested. And insurance companies, most of their fixed liabilities are in the low 4% area. So you got a lot of space before they actually become interested in treasuries. And then the incremental buyer of a lot of the last decade were sovereign pension funds, especially in Europe and Japan. And what people miss is they focus on the spread between boons and treasuries or JGB and treasuries. But the cost of hedging out the currency risk is actually quite expensive. So ultimately, if you are a German investor and you're buying U.S. treasuries instead of 10-year German boons, your positive carry is actually only about 50 basis points per year after all that currency hedging. And last year, obviously, last week, your 10-year Treasury exposure lost, 4.5%. So your 9 years of carry trade was eliminated in 1 week. So these foreign holders of treasuries are actually going the other way. They're becoming net sellers.
So, okay, Zed, I know that for some people their eyes are glazing over a little bit when you talk about these foreign carry trades and stuff. For others, it might make sense. I want to try and bring it back to kind of the real experience for a lot of investors who are not used to seeing either yields go in this direction or go in this direction as quickly when the Fed is not doing anything to stop it, right? They're not to cause it. They're not tapering. The Fed is not hiking rates. For many, they go, well, rates are supposed to stay low because they're not hiking rates, right? But that's a very different part of the bond market. What we have here is that long end of the bond market. It sounds like what you're saying is that some of the forces that were needing to take part here to buy bonds now, those forces are lessening basically as the yield moves higher. So it's kind of this thing that feeds on itself. So my question then is, why would the yield stop moving in this higher direction right now outside of, say, like another black swan economic risk or a yield curve control effort by the Fed? Should we just assume yields are going to go in one direction at this pace until one of those things happens? Or could like a bad jobs print or something turn this train around?
So you said two important things. One, that is essentially the only real money buyer right now is the Fed. All the historical buyers are steering away from fixed income right now, and so the Fed truly is the buyer of last resort. In terms of what's going to possibly slow this down or maybe not slow it down is, once again, the Fed does not think that increasing asset prices leads directly to price inflation. They think jobs need to improve to create sustainable long-term inflation. That means right now, the Fed is way more likely to do more, not less. And that's what I think the market has somewhat mispriced when you think, okay, the Fed's going to raise rates starting in 2023 rather than 2024. This is wrong in my view. The Fed, because they see this 10% current real unemployment rate, they're way more likely to do more, not less, as these events continue to unfold. So I fully anticipate them to increase their purchases and really start talking about yield curve control. And the question is, does that actually quell this sell-off in rates, or does this introduce more fear of higher rates? Because are they adding more and more inflation to the marketplace?
Interesting. Okay, so this point, Powell doesn't seem worried about that. Just real quickly, because we're out of time, any idea at what point? He said today, essentially, I'm paraphrasing, I'm not concerned about the yield move last week. I'm not concerned about the stock move until it disrupts the economy. What should we use as a way to measure when it starts disrupting the economy?
It's going to be the equity market. It's going to be very boring. Once again, if they think their job is to inflate asset prices to create jobs, it's the stock market. S&P down another 5% from here. No matter what yields are doing, they're going to think we have to do more. We must inflate asset prices to create jobs. And so they're going to increase purchases and or start talking about yield curve control.
But we don't have that. That's where you're making a call in a way, Zed, that is, it's not necessarily based on what he's told us, right? Because he said we don't want to do that. You're kind of calling the bluff here that the Fed will be more attuned to the stock market. It didn't seem like that today. He didn't seem to give a darn about stocks.
You can't show your hand too early, or else it doesn't have any effect when you make the announcement.
All right, fair enough. Okay, Zed, thanks for the thoughts here. Appreciate the details on the mechanics of what they're doing, and a little bit of a heads up that maybe we will get something after all. Is that stave stocks, though, if they do yield curve control? I mean, it's got to, right? Bitcoin's going to love that if they do.
Once again, is this in a reoccurring stage? Is more asset prices actually leading to more inflation? Do we actually, do they have the inverse effect? Does more asset purchases actually lead to asset price decline?
Right, okay.
Because it pushes yields even higher.
A certain utility curve, right, where if it's bad inflation is what you're saying if we get it. So what we should be hoping for, obviously, is good economic-driven inflation and not more asset inflation that could go the other way. All right. Zed, thanks for the thoughts here, Mr. Francis, CIO and co-founder at Convexidus.